What's going on, guys? Welcome to another episode of the Monday Mortgage Melt with me, Sam Norris, the property investors broker, everyone's favourite mortgage advisor and owner of Grand Union Finance. So today we've got another, let's say 30-40 minutes or so in store for you to ask any questions to me live about mortgages, about finance, so whether that might be bridging, development finance, commercial mortgages, anything that you can think of to do with finance, mortgages, whatever it might be. To be honest, even if you want to chuck in a few property related questions, I am more than happy to answer them for you. So, but look, I'm going to kick off with talking a little bit about some mortgage news, and we'll wait for some questions to roll in. So what I want to do is I want to kick off by talking to you about buy-to-let mortgages at the moment, because within the last week or so, actually seeing quite a few lenders reduce their rates. Which has been really, really fantastic news. Hey Sarah, how are you doing? Just seen Alan's joined as well. I'm going to say hi to people as they join. Hey Ballard Bills, how you doing, guys? Hopefully you're well. So I was just in the middle of saying that on the whole, in the last couple of weeks, we've seen that buy-to-let mortgage lenders are reducing their rates, which is really weird. And I'll tell you why it's really weird, because residential lenders are increasing their rates, and some of them, namely Barclays, are even getting rid of some of their higher loan to value products. Barclays actually got rid of their 75% loan to value product last week, which is crazy. It means, they're the reason that they've said that they're doing it, and the reason why lots of residential lenders are saying that they're doing it, is because they are massively overwhelmed, and they basically can't handle all of the new applications that they're getting. So if you wanted to know whether the property market was buoyant or not, that's a really good measure. The fact that residential mortgage lenders are having to increase rates to try and push people away from actually applying for mortgages through them. And as I said, Barclays have even gone one step further and got rid of their 75% mortgage product. Hi guys, thanks everyone for joining so far. But what does this mean? Why is the buy-to-let mortgage market doing the complete opposite and decreasing their rates and increasing their loan to values? We saw Lendinvest bring out a new 80% loan to value limited company product for buy-to-lets this week as well, or within the last week, I should say. For me, it's all about market share. The residential market is going to always be one hell of a lot more busier than the buy-to-let market. If you think about all the transactions that happen in terms of buying and selling a property, I don't know what the figures are, but I would imagine that the vast majority of those transactions are people just buying homes for themselves or selling homes and then moving to somewhere else. And so if you think of all of the mortgage transactions that happen, probably somewhere in the region of 70 to 75% of those are probably going to be residential. So you can understand why that sector is going to be so massively overwhelmed. So even the Barclays, the Santanders, the Nationwides, the Halifaxes of this world are going to be overwhelmed. Their call centres are going to be bombarded. Their underwriters are going to be incredibly busy. However, when you think of it from the opposite point of view, the buy-to-let mortgage market that's only maybe taking up 20 to 30% of all transactions that's occurring, it might even be less than that, to be quite honest with you, they are going to be actually seeing the increase in transaction numbers as a massive positive, because they have got the capacity to handle high volumes. And so they're thinking, brilliant, okay, transaction numbers are up. Let's try and grab as much a hold of this business as we possibly can. We're heading into the last quarter of the year. Let's see how close we can get to those targets that we set right at the beginning before we even knew what coronavirus was. So they are trying to just get as much business as they possibly can. And traditionally, the best way of doing that is to either bring out more flexible products, so that might be higher loan to value. I mentioned Lendinvest have gone up to 80%, or it's to decrease or reduce your rates. Now, what's strange is we are still getting quite a lot of messages or updates from lenders saying that they are pretty busy, and we can see that because every single day Ruby, our operations manager, is speaking to all of the lenders that we have current applications with, and she's finding out what their lead times are, how long it's taking them to get from application through to being actually seen by an underwriter. Hey Kara, how you doing? And some of them at the moment are taking 5 to 10 working days for that to happen. So we know that sort of pre-submission. We get an idea, and we obviously have to work that into our recommendation to clients, because it's not just about interest rate and loan to value, it's actually how quickly we can get the deal done. And if there's a deadline, it might mean that certain lenders get pushed by the wayside because we can't actually get the deal done in the specified time that we need to get it done in. So it's pretty obvious, but lenders are still busy. But the fact that they are busy and they're still pushing to try and get more business, I think is a really, really, really positive sign. It means that the lenders have a lot of confidence in the market, and it also means that they're still very, very, very much open for business. And for the back end of this year, particularly I think for the next month or so, whilst these lenders do pick up more and more and more applications, what's going to be, I think it's basically a really, really good time to be mortgaging. So this sort of brings me on to a question that I got, not live on here, although please guys, ask me any questions that you want from a mortgage or property finance perspective. This is what this video is all about, for you to ask your questions live, put me on the spot, test me, see how much I actually know about this thing that I've been doing for 13 years. But one of the questions I got off air was, is it a good time to be remortgaging at the moment? Now, as a sort of a caveat to this, it's always a good time to remortgage if it's time for you to remortgage. So this particular person was asking me this question, saying, my fixed rate comes up at the end of the month. Should I wait? Like, no, you don't want to be sitting on a standard variable rate. Let's look at what the best option is now. If it looks like the market is gonna really, really shift down from a mortgage perspective over the next few years, then maybe you might want to tie in for a short period of time and then refinance. In a couple of years' time, maybe just go on a 2-year fix rate. If the market was going to go through the roof and rates were going to go up, then it means that sticking on a 5-year might be a good idea. 13 years, you look about 25. Thank you so much. You've genuinely made my day. This time last year, actually, or a little bit earlier last year, I'm 36 now, but I got ID'd, we were on holiday, and I got ID'd at Sainsbury's for alcohol, which genuinely made my decade, because as you get older, as many of you watching may know, with every passing year, the more you get told that you look young, the more it means to you. So thank you very much for that. I'm quite happy to look 25. My wife is only 29, so she keeps me youthful, I suppose. But yeah, talking about refinancing. So if we look at what's going to be happening, 36. If we look at what's going to be happening, probably next year, towards the end of this year, the furlough scheme looks like it is finally going to come to an end, albeit there is a new scheme that the government are putting together, which means that people can go back to work for only 2/3 or a third of the time, 2/3 of the time, and get paid by the government and part paid by the work. So that might help things a little bit, but it does look like a lot of people, chances are going to come off this furlough scheme and potentially going to be made redundant, which means there's a few things that are going to happen as a result of that, and very much depends on the numbers, but people are less likely to be able to move home if you don't have a job. It's very hard to get a residential mortgage. Sorry guys, call came through there. It's very unlikely that, sorry, where was I? Got completely caught off. So yeah, if unemployment levels go up, then it genuinely means that the level that less people are going to be able to afford to move home. They can't get a residential mortgage, and some even in the really the bottom end of that might get into such difficulty that actually they can't even afford to keep up repayments on their current mortgage, which should lead to a relatively steady decline in the number of transactions. As I was saying earlier on, remember the vast majority of mortgage transactions that happen are residential. They're not buy to let. Probably about 3/4 are going to be residential, and so that part of the market really propels the overall property market in general. And if those transaction numbers dwindle, then that's obviously going to have that knock-on effect. We've then got the end of this stamp duty holiday that's going to happen in March. Who knows if that gets extended, if furlough finishing really hits the property market hard. And let's be honest, no one knows really what kind of effect that's going to have just yet. But if it really does hit hard, who knows? The stamp duty holiday might be extended in order to further fuel the market. But let's say that it doesn't. That's going to be like a double whammy effect to the property market, because buyers and sellers, what's going to happen is there's going to be a massive disparity in terms of what they think the value of a property is. And this is where stagnation in the property market always occurs, when there is a differential, or is it, I'm just going to use an easier word, there's a difference between what a seller thinks their property is worth and what a buyer is willing to pay for it. Now, if there is less competition for buyers, then there's going to be less of this sort of driving up of prices that we've seen over the last few months, and then couple in the fact that now they're going to be having to pay thousands of pounds in stamp duty as well, chances are that's going to come off the top level. But as we've seen previously, sellers can take a long time to actually get their head around the fact that the market is actually dropping. They've been promised these amazing prices by their estate agents. They've seen their neighbours get all these incredible values for selling their properties, and they want a piece of the action, and they're disappointed when these offers don't materialise, and they will reject offers that are below that amount that they've got in their head. What happens is we then usually see a bit of a plateau, a bit of a stagnation, where we're trying to get the two onto the same level again, and I can see that happening. Now, the real positive thing that we have this time round, when you think of when this has happened previously around the kind of the credit crunch time and all that kind of stuff, is that we have mortgage lenders that are willing to lend money. Yes, they might be on a slightly higher interest rate than we would like, because, as I said, residential lenders have been increasing their rates, but lending is there. There's something like over 70 trillion pounds worth of, sorry, it's not quite 70 trillion, it might be 3 trillion pounds worth of money that's waiting to go out in terms of property finance, from either from lenders or from funding lines that smaller lenders will have, and so there's money to be going out the door basically. And so it's really I'm really hopeful that any kind of dip in the market, we're going to see a recovery pretty well. The UK property market is pretty resilient. And we have seen in the past that when it gets hit, it usually means that we see a recovery relatively quickly and relatively steadily. So I'm really hopeful that this is going to remain the case, and I'm hoping again that it's going to be buoyed massively by my friends at the mortgage lenders, really pushing this market forward. Now, I've got a little question that's come in from Salim. Hi Salim, I wanted to ask, what do you think about property crowdfunding? I think crowdfunding is absolutely fine. I don't help my clients with a lot of it. I work with some crowdfunders that I introduce some of my borrowers to. But the way that I kind of see crowdfunding is as part of a sort of what I call a funding stack, I think you'd probably call it, which is, so for me, crowdfunding tends to be used on development projects. So for those of you that are watching that are developers or you're fledgling developers, this would be pretty helpful for you, I think. So crowdfunding, as I said, mainly used for development projects. And how that works is that they will look at helping to fund acquisition of sites as well as potentially works on sites. Very similar to development finance. However, it can be a little bit more costly than borrowing debt. Crowdfunding is equity funding, not debt funding. And debt funding tends to be on the whole a little bit cheaper depending on where you are in terms of your level of experience. But let's say that you've got a half decent amount of experience. The way this stack would work is you have to understand the difference between a first and a second charge as well, which is really, really important. A first charge, by way of a loan, is the first loan on your property on the site. So if you compare this to a mortgage, this would just be like a normal residential mortgage or a normal buy-to-let mortgage. It's a first charge, or we call that in development finance terms the senior debt. If you were to sell that site, that gets repaid as priority first. Okay, so that's what goes down first. That's our basic level of our funding stack on a development project. Now, if you need a little bit more than the sort of the loan to value or the loan to GDV that particular development finance would go to, so typically, the best development finance out there can be found at around the 50% loan to GDV mark. GDV is gross development value. This is the value of the site once you've completed all of the work. That's where the best funding is. If you need a little bit more than that, the next level is what we call stretched senior debt. And that is lenders who will lend a higher loan to value, loan to GDV, sorry. So they might go anywhere up to potentially 70%, but these lenders are still going to curb their maximum on the acquisition to probably around 65 to 70% loan to value. So that's how much of that loan will contribute towards the purchase. So we've got to our stretched senior debt lenders and we still need a little bit more. That's when we might look at a second charge. Now in development finance terms, we call that either junior debt. So we've got the senior debt, might be junior debt. Some people will call it mezzanine finance because it sits above the senior debt at the bottom, the first charge. And that is your second charge. It tends to cost a little bit more. And some lenders some first charge lenders or senior debt lenders will lend their own second charge or mezzanine finance, and some will require it from a third party. So another lender will come in. So we'll have two lenders at the same time. Now that can take us up to, potentially 75% loan to value. It might take us a little bit further in terms of the loan to costs. If you still need to make up the difference, that's when we would potentially look at equity funding to make up the difference. And equity funding doesn't necessarily have the same restrictions in terms of loan to values and loan to GDVs. And in some cases, it can actually take you all the way up to the limit in terms of your 100% of the purchase price and 100% of the cost of the work. So it will bridge that gap basically. So Salim, I don't know if that answers your question in terms of crowdsourcing, crowdfunding. It's basically what I would say it's like the cherry on the top. You go down the debt route first and you find your first charge lender to lend you your development finance. If you need a little bit more, we get some mezzanine finance to sit on the top. And then if we need any more than that, that's when the difference can be in terms of getting the crowdfunding in, which tends to be the most expensive type of funding. So you want to limit it to as small an amount as possible. Some people use crowdfunding to fund all of their projects and don't use debt at all. That's of course a preference. Maybe I'm biased because I'm a broker and therefore debt is what I deal with day to day. But that's where I see things, and that's how crowdfunding I think works into what I call the debt or the funding stack, which is what I just went through there. But guys, don't forget to ask any questions that you've got, whether it be with regards to mortgages, whether it be in regards to bridging finance, anything like that. Celine, good. Okay, hopefully that really helped. If you've got any, if anyone's got any sort of personal questions, i.e. you've got your own site on the go, or you're looking at a particular bespoke, or you need some bespoke sort of advice on something and you don't necessarily want to ask questions on here, I fully understand. Use my direct message, that's absolutely fine. Hit me up in my DMs, as the kids would say. See, I might be 36, but I still know my terminology and my lingo. send me over any messages that you like, and I can deal with them off air. But if you've got any questions that you want me to answer on here, please just throw them out there, because I'm more than happy to help. Now, there was something else that I wanted to chat about, which was all to do with sort of more on the bridging and development finance. So I'm glad that you asked that question, Salim, because it kind of leads me into this a little bit, which is I recently did a sort of a presentation for some property investors at a property event last week, and I thought, I haven't done it for a while, and I thought, I know what I'm going to do. I'm going to do a case study, and this was a really interesting case study, because although fundamentally a lot of it was to do with the investor being pretty savvy and really being up to date on their planning knowledge and their PD rights and all this kind of stuff, the funding on it was obviously a massive part of getting the whole job done, and because the work that they were doing, they were covering themselves, and it wasn't sort of actually knocking things down and building it from scratch. The bridging that we got on it was actually what we call heavy refurbishment bridging, because there were no real huge structural changes to this particular project, and I thought I would share this with you now, because I think it's really interesting. Now, this particular project, what the client's doing is, it's based in the West Midlands, by the way, and what they're doing is they found a property that is what we call semi-commercial or mixed use. There was a retail unit on the ground floor, so commercial space on the ground floor, and above it there were two bedroom flats. Now, what the end goal of this to do was to try and increase the value of the overall property. Now, I won't go into the individual numbers of figures, because number one, I'll probably confuse myself, and number two, I want to focus really on the how we got this funded, and the importance of understanding what you can and cannot do when it comes to these types of properties and how you can add value. Now, what we wanted to do is we wanted to obviously add significant value to this, so that when we came to refinance this onto a longer term mixed use semi-commercial mortgage at 75% loan to value, we were pulling all of our money back out of it. So how do you take a property like that and add value without just renovating or refurbishing the units that are already there? Well, the best thing to do is to create more units, but how do you do that? Usually you'd have to go through a really long planning consent application process, which can take ages, can take months, and that can scupper you purchasing a deal. And it also, to be quite honest with you, you want to buy the property, you want to do what you need to do, and you want to get back out again and start looking for the next deal. So the quicker you can do these things, obviously, the better. Now, what we did here was, or what the client did here, was they knew that they could get PD rights, permitted development rights, so you don't need planning consent, to split the retail unit on the ground floor into two. Now, they actually decided to do this pre-COVID, but as it turns out, was really helpful, because so many businesses were sort of going out of business, and those that were struggling were looking to downsize their premises. So actually, by creating two smaller retail units, they've actually opened themselves up to a larger proportion of the market. There's high demand for these sorts of units at the moment, which is fantastic. So they knew that they could get permitted development in order to split them. Now, for those in the know, and there might be some of you watching thinking, I know where he's going with this, permitted development rights also allow that you can have two residential dwellings above any commercial property, which is massively helpful. So obviously here, we don't just have one commercial unit anymore, we've got two. So what's really beneficial here is that we can convert the two that are above the whole thing as it was into four, because we can split them. So as you can see, there's a commercial unit, then there's two residential above twice. So automatically we now have more units, more opportunity, more value, most importantly. Now, you have to do this the right way round, because the PD rights you couldn't just go straight in and say, right, I want to have permission to create 4 residential units above this retail unit and do it the other way around. You have to get the PD first to split the retail units. Then afterwards you apply for the planning once you've the PD consent, once you've got those done. Now, what was great was all the investigation into the fact that this could be done was completed prior to submission of our application for the bridging finance. Now, on this, I must add a little caveat that the client had enough money to do the works themselves. We were just applying for a bridge. We got 75% on a heavy refurbishment bridge at 0.95% on this. So considering that there is a commercial aspect to it, that's actually really, really decent. At 75% loan to value as well, very, very decent. And so they've done all of this work. They've gone in. They've got the sort of the pre-consent, if you like. They know they've got their planning consultant has given them enough information to confirm that this is going to be the case, which meant that the bridging lender was comfortable. Now, what we also did as part of this, just as a side here, is we made the bridging lender aware of all the works that were going to get done, the cost of that. We even proved that the money was in the bank to cover that, which gave the lender a lot of confidence that the project was going to go ahead. And to even add more weight to that confidence, we actually put together a development pack which showed not only the development appraisal, so all the high level figures on this, but a schedule of works from the contractor and details of the project manager who was going to look after this as well. So it was a really detailed application at the beginning. It's really important to do that. But what it meant was the lender was really, really comfortable, and we got the finance wrapped up in less than a month, and they were able to plough on and start and get all the works done. Now, in terms of the exit on this, again, we got to 75% loan to value. All of those 6 properties were rented bar one by the time that we did that. Both the retail units were leased, and 3 of the 4 residential units were taken as well, which was which was brilliant, basically. And although that the rate that we got at the back end for the commercial mortgage, which has to be commercial because there's a commercial element, so it's commercial lender, semi-commercial mortgage, was just shy of 5.5%, which you might go, oh God, that sounds a lot. But it net cash flowed them over 20 grand a year. That's net. And it actually released them just under 20 grand above their original contribution. So you talk about money in, money out deals. This wasn't just money in, money out. This is money in, money out, and then a little bit more. And they were able to pull out an extra 20k on top of what they put back in. So if they wanted to go and do exactly the same project again, exactly as they'd done it, they would still have 20 grand that they could just keep in their bank account in the background, which is fantastic. So money in, money out, plus an extra 20k. Now that is what I call a seriously, seriously good deal. And the whole thing was refinanced within 10 months. So we bought it, the building work was complete by about sort of 8.5 months it took to do all of that. And we started the refinance process just before then. So basically, we always start the process just before what we call PC, practical completion of a development site, because what we do is we get all the paperwork done, we get the initial underwriting underway, and then once we've got PC, practical completion, signed off, that's when we go in and get the surveyor in there. So we get all the underwriting done as much as we possibly can before the valuer goes in, does their report, sends that back, and then we've got a nice commercial mortgage offer waiting for us at the back end. It's just over to legals then to switch over the charge and pay back the bridging lender. So we did that all in 10 months, which I think was great. And as I said, this client ended up walking away with an additional 20 grand over and above his initial investment into this property. And hang on a sec, I've just remembered something. I've told you this story slightly wrong, because we didn't even refinance onto 75% on the back end. We only actually went to 65%, and we still managed to pull out the 20. So that was just because we wanted to take advantage of slightly better rates. It was still just shy of 5.5%, but if we'd done it above that, it would have been a lot more. But we did it at just under 5.5%, and this was on a 2-year fixed rate, with the client looking to refinance this again in 2 years. Hopefully, the market going up a little bit, and this would lead to more income or more money that he could pull out to go and then continue to buy even more properties. like I said, I did stress this at the beginning. This client has done this a few times before, has a buy-to-let portfolio in the background as well. So it's a little bit more advanced than maybe some people that are watching, but it just goes to show these deals can be done. And even if you didn't have any experience, you could still do that deal. There are lenders out there that will allow you to do it as long as you've got the right team involved. And it's why it's so important to get a good contractor, project manager, the right accountants, solicitors, brokers, whoever, you name it. I know I just said brokers there, and most of you watching going, well, shouldn't you just tell everyone to use you, Sam? That's not the way I do things. If you like what you hear, come and speak to me. That's absolutely fine. But I'm not here telling you that I should be your broker. That's not my place. But get the right team involved, because getting bridging and development finance becomes a hell of a lot easier when you can put together a pack that you can send to lenders. So guys, look, we've gone to the 30-minute mark. If any of you have got any last-minute questions, I'm happy to stay on for probably another 5 to 10 minutes, just to cover off any last final mortgage or property finance related questions that you might have. Here we go. Sources has got one. So, hi Sam. How much more favourable do rates become once you get a few mortgage agreements under your limited company? Good question, and the answer might surprise you. Now, I'm making the assumption that what you mean is the difference between, say, for example, you had one property that you purchased within your limited company versus another company that maybe had 5 or 6 or 7 properties. Hopefully that's correct. Sources, have I got that right? That's the question that you're asking. Just put a little thumbs up or something just so that I know what your that is the right question. I think I've got that right. But anyway, even if it isn't, let's answer that question for the time being. Yes, yeah, exactly what I mean. A second property versus a first property. Yeah, okay. So it actually doesn't make too much difference, if I'm being completely honest with you. But there's a sort of a caveat to that. So people get confused when it comes to limited company ownership structures, and it all comes, I think, in the term limited. Now, the comparison I use, which is quite a good one considering what I do for a living, is using the word mortgage. Okay, so mortgages, the word mortgage means till death. Now, very few people nowadays have their mortgage until death, but it's still got that name. We're not going to change the name mortgage because people know what a mortgage is. And a limited company, the term limited company was brought about in like the 1700s or something. Although I did a history degree, in fact 2, that's how sad I am. I should know roughly when that was, but I don't. It's probably around the 16, 17, 1800s, somewhere in that 300 year region. And that was the name of it because you had limited liability as an individual that was a shareholder or director of that particular company. The term has remained the same, the meaning has changed. You do not have as much protection as you once did, and especially from a lending point of view, you as the individual are still the most important thing. So whether you're buying in limited company or whether you're buying in your own sole name, your own personal experience, your own personal situation will be the difference. Okay, so that's one thing I just wanted to cover off, sources first, so that you get that. So the next thing is, let's look at your personal circumstances. If you are a homeowner, then you are just down as a first-time investor. You will have a certain number of lenders that are going to be available to you that are going to be happy to lend first-time investors on a buy-to-let basis. Let's just keep it simple for the time being. If you don't own your own main residence, you are a first-time buyer, first-time investor. Whether you're buying in limited company or whether you're buying in sole name, okay, it's the same. And the number of lenders dwindles massively, and chances are you might even be subject to a more standard affordability calculator that you would be used to seeing for a residential mortgage. They'll calculate this based on your personal affordability to pay the repayments, or even if it's interest only, still paying back or making the monthly payment on it, which is something you need to be wary of. Now, a lot of my clients get round this by following the buy, refurbish, refinance model, because you either buy cash or with a bridge on the buy, refurbish, refinance model. And so bridging lenders, if you are going down the route of needing finance for it, are much less bothered by whether or not you've got a portfolio or not, or you've got experience or not. So it's really important to understand that by the difference between the bridging criteria and the mortgage criteria, much less flexible on the mortgage side. So if you then buy the property using a bridge and come to refinance, say 6 months later, obviously you now are a property owner. You're not a first-time buyer anymore. And you're not even a first-time investor. So the number of lending options opens up massively to you. So basically, just to summarize that, sources, you are, whether you're buying a limited company or sole ownership, your personal situation is what counts towards whether you can get mortgage lending or not. Whether it's your first property or second property is the same regardless. If you've got a property in the background in terms of your own main residential mortgage, then it's very much helpful because you're not seen as a first-time buyer, just a first-time investor stroke landlord. If you don't have something in the background, this is your first property and you're buying it with a mortgage, you might come up against some issues. Most likely that you need to go through this more standard affordability calculator that you would do if you were buying a property as your own main residence. They would actually look at your affordability. One thing also to take into account with that, if you're a first-time buyer, first-time investor, is that they'll also have a look at where the property is. Because if, say, for example, you live like where I grew up in High Barnet, North London, and you were looking at buying a buy-to-let in Finchley, which is just down the road, for those of you that don't know, the lender might be a bit suspicious. You're buying a buy-to-let, but are you not just going to go and live in it? They might be a bit concerned about that. They may also look where you work, and say, for example, you worked in Finchley, they're going to be pretty dubious as to whether or not this is actually not what we call a sort of a backdoor residential. You're actually going to end up living there. So, but if you lived, say, as I said, where I grew up in High Barnet, but you were buying where I live now, which is in the West Midlands, the lenders are much more inclined to understand that this is probably going to be an actual rental property. So that's something else just to sort of take into account, that if you are going to be a first-time investor and trying to get a mortgage, this is something that you might come up against. So right, so we've hit 37 minutes. Time for a few more questions if any of you have any. Just a few more because I've got to get to the gym, because otherwise I get fat. And then I start looking old, so I don't look like I'm 25 anymore. For those of you that have joined late, I got some compliments earlier that apparently I don't look like I've been in this industry for 13 years. Trust me, when I'm not using the old Just for Men, the white hairs will definitely show up that I have been in this very stressful industry for quite some time now. But cool, I'll give it a couple more minutes for any last minute questions to pop in. Black Diamond, yeah. I joke sometimes that during COVID I was keeping Just for Men in business all by myself. As you can see, not too many white hairs anymore, because they're nicely covered up. Although I do get a little patch here, which isn't showing too prominently. I've got this brand new. Before my age, I better get to the gym before my age shows. I've just to let you guys know, I've upgraded my machinery, my hardware today. I've got brand new tripod, and it's got this great ring light in it, so it puts some light onto my face to help me look hopefully even more younger. Maybe that's why I look so young on this particular one. ICO, yes, this is recorded. Well, it all very much depends on whether Instagram is going to allow me. Sometimes it allows me to download the video afterwards, sometimes it doesn't, but either way it should let me add it onto my IGTV, which I'll do straight away. So if you haven't had a chance to hear like the entire video, you can find it on there. If I can download it, it will find its way onto YouTube at some point. But I'll tell you what, while I've got you guys here, let me ask you a quick question. As many of you know that follow me, I also have a podcast, the Game of Loans podcast. I'm very proud of that name. But I have been asking recently whether it would be useful for me to add the audio of these videos onto a podcast. So for those of you that don't necessarily like watching videos, you can actually listen to it on a podcast. So if you think that would be a really, really good idea and that would be helpful, let me know. Just, I don't know, stick a thumbs up or something in the comments to let me know, because if you do, then what I'll do is, if I am able to download these videos, if Instagram decides this week that it's going to let me, then I'll start doing that, and even if it means adding in a third, I try and get 2 episodes out a week, but that's gone down to 1 at the moment just because we're so massively busy at Grand Union. But excitingly, in terms of developments, I've managed to now get my operations manager passed on some of the admin work that I'm doing, which means I can now really focus on the marketing part of our business, which means more of these types of videos, more great content, hopefully. Please add the audio to the podcast. Great. Okay, I'm going to start doing that as of next week. So if you didn't get to watch this entire video, Game of Thrones, great. I came up with that like ages ago, and I was trying to find something to use it for. The idea of a podcast came up. So just before, or just when lockdown was about to happen, that's when it started. We're now up to 57, 58 episodes. The next episode, by the way, with the guys at Premium Property. If you don't follow those guys, look them up and go and follow them. But they're going to be on the podcast on Thursday morning, 8 a.m. Check out the link in my bio, and it will take you through to any of the platforms that you prefer to listen to your podcasts on, and you'll be able to subscribe. If you do listen to it, by the way, leave me a little review, preferably with 5 stars. It does both help me in terms of making me feel good about myself, but it also does help promote the podcast a little bit more. Loads and loads of great interviews on there. It's a mainly interview-based podcast, but obviously if I add in the audio from these as well, then it will be a little bit more of me as well on top of that. But great, lots of thumbs up, so I really, really appreciate that. I'll definitely start doing that. Guys, last opportunity for any questions before I jump off and head to the gym. Going to give you about 2 minutes to respond to that. By the way, while I do that, just to let you know that Wednesday this week at 7 p.m, I will be dropping a video on my YouTube channel. Again, hit the link in my bio to go and subscribe to my YouTube channel. I'm going to be putting a YouTube video up there on Wednesday at 7 p.m, all about why I believe you should have what is known as a hybrid property structure, and to do that you need 2 limited companies, and why you need 2 limited companies or 2 property companies working side by side to take your property business to the next level. So if that's something that interests you, go and click on the link in my bio. Go and subscribe to the YouTube channel, because that video will be hitting at 7 p.m. on Wednesday. Okay, guys, don't think we've got any more questions coming in, so I'm going to bid you adieu. Have an awesome Monday evening. Sending loads of positivity, and hopefully you're going to have a massively successful week. Any of you that have any other questions that haven't had a chance, send me a direct message. I'll come back to you as soon as I possibly can. But for now, guys, I shall see you later on. Have an awesome week. Thanks ever so much for watching. It's much appreciated. See you later.